Hi, I'm Ben Squires, Chief Investment Officer at NGS Super, and it's timely that I provide an update given the recent volatility we're experiencing across global share markets. At NGS Super, we diversify across asset classes and we are well positioned to protect our members' wealth over the long term. Now, in this update, I'm going to provide a summary of the causes of market volatility and how NGS Super has positioned the portfolio, including looking at the impact on performance. I'll then talk about the various ways we manage the portfolio in periods of volatility and finish on reflecting on the longer-term prospects for returns. Now, as we've seen, global equity markets fell sharply in March as investors concerned mounted over the potential impact of a US-led tariff policy. And on the 2nd of April, the market sold off when tariffs were announced and were much worse than anticipated. The introduction of aggressive tariffs on foreign goods, followed by retaliatory measures against the US, has raised fears of a slowdown in economic growth and potential recession. The S&P 500, which tracks the largest 500 US companies, declined 4.26% in March, and an additional 9.2% in the first week of April, while the tech-heavy NASDAQ fell 6.19% and a further 10.5% in April, led by a sell-off in the Magnificent Seven stocks. As investors reassessed the risks associated with escalating trade tensions, exposures to US equities was reduced, while other regions such as Europe and emerging markets showed greater resilience. The MSCI All Country World Index declined by a comparatively modest 3.35% over this period. At the start of the year, major institutions, including the leading investment banks, assigned a near zero probability to a US recession. However, as economic conditions deteriorated in February 2025, these forecasts were revised to reflect higher downside risks. In contrast to broader market consensus, NGS's investment team identified rising geopolitical risk and economic risks as early as 2024, a view we shared at our annual member meeting last year. In response, we took a series of defensive measures within our portfolio, which include taking profits from strong equity market gains, maintaining a market weight exposure to equities, increasing our allocation to defensive levers such as bonds and gold, and implementing hedges against equity market downturns. These strategic adjustments have materially benefited NGS's members relative to other super funds. As of February, the diversified MySuper option performance ranked in the first quartile for the financial year to date, and we anticipate our performance to continue to outperform for the one-year period ending the 31st of March 2025, based on the Super Ratings Balanced Fund Survey of the top super funds. While the diversified MySuper option posted a negative 1.5% return for March, and share markets have fallen further in April, the diversified MySuper option continues to deliver positive returns for the financial year to date, returning 3.65% as of the 8th of April. There was also some welcome relief on the extent of tariffs by the US announced on the 9th of April, and markets in the US rose over 9%, and the Australian market saw similar gains over this period. Now, this heightened volatility is a reminder that timing the market is very difficult, and the best strategy as a long-term investor is to resist the temptation to switch investment options and seek financial advice. Our portfolio is designed to weather different economic conditions, including periods of market volatility. And despite the declines in equity markets during February, March, and into the start of April, long-term performance continues to be strong. Market corrections and rising volatility often tempt investors to switch investment options or increase cash holdings. However, history has shown that successfully timing the market bottoms is exceptionally difficult. Now, staying invested remains the most effective strategy for long-term wealth accumulation. As professional investors, we employ a range of strategies to generate returns while managing downside risk. Our portfolio spans a diverse mix of asset classes, including infrastructure, real estate, private debt, commodities, and alternatives, all of which continue to offer attractive return potential. Additionally, when our signals indicate a shift in market conditions, we have a suite of instruments that allow us to swiftly adjust our exposures. Now, despite alarming headlines, the NGS investment team conduct in-depth analysis to assess economic and market dynamics, allowing us to position the portfolio optimally in response to prevailing conditions. Looking ahead, the next 6 months presents uncertain macroeconomic landscape. As such, we assign a probability-weighted scenario to key risks and opportunities to guide our investment decisions. Over the long term, we see significant upside from structural trends, particularly in artificial intelligence, automation, human health, and climate change, to name a few. And we have several companies in our portfolio that are positioned at the intersect of these trends and have potential to disrupt entrenched monopolies. Furthermore, we anticipate strong productivity gains across all sectors in the economy over the long term, given these advancements in artificial intelligence, which should more than offset demographic challenges faced by many economies around the world. These shifts present compelling opportunities for long-term investors, and our portfolio is well positioned to capitalize on them. Now, at NGS, we construct balanced, risk-aware portfolios that don't rely solely on share market returns, ensuring that members are supported no matter what the market is doing. As market conditions evolve over the short term, we'll continue to provide further updates on how these changes impact the investment portfolio. It's been a pleasure providing an update, and I look forward to speaking to you shortly.